Western companies operating in China are the most pessimistic they've ever been about the outlook for business and are calling for more government measures to instill confidence among foreign investors. That's according to a pair of business chamber reports published this morning, gauging views among the U.S. and EU companies operating in the country. But our next guest says that with so much bearishness all around, all the bad news could be priced in. It's difficult to get even more bearish. Ruchir Sharma is the chair of the Rockefeller International and founder and CIO of Breakout Capital. Ruchir, thank you so much for joining us, sort of a longtime watcher in this space. How are you thinking about how this year has evolved for China? So much optimism about the reopening that kind of failed to pan out in the economic data. And now here we are, kind of depressed about the state of affairs and worried about major credit events.
Yeah, so I think that it's amazing to see how quickly sentiment has soured on China. I've been bearish on China for quite a while now. And my logic was the fact that if you look at the demographics, the debt buildup, and the fact that they're at the wrong end of the deglobalization curve, that China's economy was poised to slow down. In fact, I wrote a piece last year saying that China's trend growth rate is likely to slow down to a pace of below 3%, possibly 2.5%, and why it may never be able to catch up to the American economy, at least in our lifetime. And what I find now is that everyone's saying the same thing, which makes me wonder if it's in the news, is it in the price? So that's where I am. I think there's been a huge sort of change in sentiment about China. We are now finally waking up to the reality that this economy is likely to slow down dramatically. Its miracle path is over. But I'm just concerned about the fact that everyone has now reached the same conclusion. So what comes next, knowing very well that the consensus is rarely correct? So
what's the play then? Are you talking about the pricing when it comes to Chinese equities? The Hang Seng, the CSI 300, is that where you're looking at sort of beaten up opportunities?
Yeah, I think so. I think, there are some quality companies still in China, especially in the tech space, in the EV space. We've heard so much about China's dominance in the EV, the battery space, and even some consumer franchise names that may still be okay. Now, having said that, I'm still reluctant to go full into China just now, although for the first time I'm nibbling in, because I totally realize that if you look at the normal cycle, then we seem to be at peak pessimism, but there is a non-significant probability that this ends in a full-scale crisis, because remember that America in August, September of 2008, people were thinking as late as August of 2008 that the economy, is in trouble, but should be able to avoid a crisis. And yet, when any economy faces a property market crisis, it usually ends up in being a full-fledged economic crisis. So therefore, it's a very debatable thing where the consensus now has reached the same conclusion that we were saying a while back about the Japanification of China. But now what comes next is a fine line, which is that in the normal bounds, this seems like peak pessimism, but there is a non-significant probability that you still get a full-blown credit crisis, and then the government comes in and gives all sorts of support measures, and that marks the bottom. So I think it's a fine line between the two, and that's what I'm looking at very closely just now.
It sounds like you're putting it on your watch list, but maybe you don't want to go, really massively deploy capital right now because there could be a better entry point?
Exactly. That's like the right way to characterize this, which is that start nibbling, put it on the watch list, but be aware that there could still be one final leg down, which is a crisis leg, just like America or other economies on the brink of a full-fledged property crisis had. So I think that that's exactly where to be just now.
What about sort of the non-cyclical factor, the structural factor, and you alluded to it, that they're on the wrong end of deglobalization, friend-shoring. They're in basically a proxy a trade war with the United States, and there are major geopolitical tensions when it comes to Taiwan, and that could be sort of an event that would really reshape geopolitics if China were to invade Taiwan. How are you thinking about those factors outside of the normal, kind of cyclical ebbs and flows?
Yeah, I think that's like just impossible to try and predict about what happens with Taiwan because that's such a wild card out there. But what we do know is this, that you just step away, which is that this trend of friendshoring has clearly picked up. You have many economies around the world that are benefiting from the fact that American companies or even European companies still want to offshore. They just don't want to do it to China anymore. So you've got economies in Southeast Asia, from Vietnam to Indonesia, countries like India, closer to America, such as Mexico, even in Europe, economies such as Poland. All these economies, I think, stand to benefit the most. So that's really, for me, the real play out of this, that you've got these two giants out there which are engaged now in some sort of a Cold War, which is US and China. But you've got these whole host of economies around the world that could really benefit from this because the trend of offshoring still continues. The wages in US and Europe are still far higher than what the wages are in some of these economies. So many corporations still want to go overseas, just not to China anymore.
And then, so do you want to skew away from those, Chinese players that are exposed to that, but still play, the consumer story and the fact that there is such a huge population and much of it remains untapped? Do you think that that's still, a rich place to go investing?
Exactly, and especially because the last decade, these economies or even the stock markets in many of these countries have really not done much in dollar terms. As you know, the last decade has been all about America's decade as far as stock market returns is concerned. And many of these economies haven't done that well in terms of delivering great returns. So I think that those are the places where you can find some bargains, and yet you still have a growth story left in front of you. So absolutely. So those are some of the top picks, the likes of Indonesia. India, of course, has got a lot of hype, but even the likes of Mexico and parts of Poland, these are all economies that you can find plenty of consumer plays, as you say, or offshoring plays if you can find them, that will really benefit from these two elephants fighting out in the jungle.
All right.